Welcome to the Explainer. Today, we're unpacking a really fascinating, highly effective options trading strategy developed by veteran retail trader Brian Terry. Look, if you're searching for a way to generate steady, consistent income without needing a crystal ball to magically guess the market's next move, you are in exactly the right place. So let's jump right in. First things first, let's do a quick reality check. Are you just completely exhausted by the stress of directional trading? I mean, so many traders spend literally countless hours staring at charts, trying to predict if the market is going to rally or crash. It's stressful, it's mentally draining, and honestly, it's incredibly difficult to do consistently. But what if you could trade in a way where the market's direction just didn't matter all that much? Well, here's our roadmap for today. 1. A strategy for any market. 2. Step 1. The long straddle. 3. Step 2. Selling weekly options. 4. Rules for trade management. And 5. The risk and reward profile. All right, kicking things off with Section 1, a strategy for any market. Brian Terry calls this his delta-neutral options strategy, and what's really compelling here is the promise it makes, which is consistent income without picking a direction. Instead of betting on wild, volatile market swings or, trying to catch the absolute bottom or top of a trend, this approach focuses entirely on building a low-stress, steady income stream. It operates primarily on the SPY, which tracks the S&P 500, so that gives us a highly liquid, super reliable market to work with from the get-go. Moving right along to Section 2. Step 1. The long straddle. Just as a quick structural refresher for us, a straddle simply involves buying a long call and a long put that share the exact same strike price and the exact same expiration date. Normally, a straddle makes its biggest profit if the underlying asset makes a massive move in one direction or the other. But as we're going to see, Brian uses this in a really clever, purely structural way. The crucial point here is exactly how Brian constructs this specific straddle. He buys a straddle on the SPY, but he goes out 90 to 120 days until expiration. And he sets a strike right at the current price of the underlying asset, so right at the money. Think of this 90 to 120-day straddle as the foundation of a house. Obviously, it costs money to pour a solid foundation, but without it, you can't build anything safe on top. This long straddle is our ultimate insurance policy. Let's ground this abstract math with a real, specific example to put things into perspective. Imagine the SPY is at a strike price of 600, and we're looking at an expiration about 110 days out. Buying that call and that put costs exactly $3,737. And this brilliantly illustrates the safety of this whole strategy, because that $3,737, that is your absolute maximum loss on the foundational trade. You know exactly what your worst-case exposure is the very second you click buy. Which brings us to Section 3, Step 2, Selling weekly options. Now look at how these two steps work together. Step 1 was our long straddle, right? Our foundation. Now we introduce Step 2, selling a weekly strangle. This simply means we're selling short-term calls and puts against our long-term foundation. If the straddle is the house, selling these weekly options is basically like collecting weekly rent from your tenants. The goal is to collect enough rent every single week to eventually pay off the cost of the house entirely, and from there, start generating pure profit. When you picture the profit and loss curve for a strangle, you'll see a green profitability zone right in the middle. The position stays profitable as long as the short call and the short put end up anywhere inside that green area by expiration. Brian's goal is to collect about 1% of his risked capital each week. To do this safely, he places those short options pretty far away from the current price, typically 1.5 to 2 times the expected move. He's intentionally giving the market plenty of room to breathe while he safely scoops up that premium. Now, any experienced options trader listening right now is probably thinking, wait a second, selling a naked strangle has unlimited loss potential. And honestly, you'd be absolutely right. By itself, a strangle is incredibly dangerous. But remember our foundation? Because we paired this short strangle with our 120-day long straddle, those two components completely offset each other. That terrifying unlimited risk, it's completely neutralized. The long options cap your losses, creating a highly controlled, incredibly safe environment. All right, Section 4, Rules for Trade Management. The management of this actually starts before you even enter the trade, 18. That is your magic number, your gatekeeper here. Brian only opens a new delta-neutral trade when the VIX, the volatility index, is low, specifically sitting below 18. Why? Well, because a low VIX means options are cheap. That long straddle foundation we need to buy will cost you significantly less.
Plus, if the VIX suddenly spikes later on, the value of your long straddle could actually jump, giving you a really nice, totally unexpected gain.
Once you are actively in the trade, you follow a strict, no-nonsense defensive playbook. If the SPY makes a big move away from your initial strikes, don't panic. You just recenter the straddle by rolling the longs to the new price, keeping that same expiry date. That stops the trade from leaning too heavily to one side. But what if a short call or put gets threatened? Brian simply rolls that short option out to the next week and adjusts the strikes to keep it safe. The golden rule is, never let short options expire in the money. And if the market is just being absolutely chaotic and your adjustments aren't working, leave your ego at the door. He simply closes the whole trade and starts over.
Speaking of closing trades, there is a hard and fast chronological rule you absolutely must follow: the 60-day eject button. No matter what is going on in the market, Brian closes the entire delta neutral trade the moment that long foundational straddle hits 60 days to expiration. Why? It all comes down to theta decay. As options get closer to expiring, their value starts eroding faster and faster. By ejecting right at 60 days, we stop theta from eating away the value of our precious foundational insurance. Finally, Section 5, the risk and reward profile. When Brian Terry was asked to rate the risk of this strategy on a scale from 1 to 10, he gave it a 2 or a 3. I mean, that is incredibly low. Because the whole strategy is designed from the ground up to remain delta neutral, you completely avoid directional bias. You're not waking up in a cold sweat at 3 a.m. to check the overnight futures. The structure of the trade, paired with those careful management rules we just covered, drastically minimizes volatility-related stress. But okay, let's be pessimistic for a second. What is the absolute worst-case scenario? According to Brian, it's when the SPY experiences a sudden, massive move that just blows straight through your short call or put, leading to a potential assignment. But again, how do we mitigate that? With those long options. Because you own that foundational straddle, your losses are offset. Brian notes that even a 1% sudden SPY move has a pretty minimal impact on the overall position. And even in a huge 5% market shock where your adjustments fail, you can usually just close the trade. And because of how the mechanics work, it's actually often still slightly profitable by that point. So let's pull all of this together and summarize the incredible real-world benefits. First, it targets consistent income, aiming for around a 1% weekly return on risked capital. Second, it is fundamentally low stress because you are stepping completely out of the exhausting game of guessing market direction. And third, this might be my favorite structural benefit. It's highly scalable and flexible. Brian notes that when he wants to go on vacation, he simply stops selling the weekly rent options. He just pauses, heads to the beach, and lets the long straddle ride passively. Your trading adapts to your life, not the other way around. Which brings us to the ultimate question you have to ask yourself today. Is it time to finally stop guessing which way the market wind will blow? Are you ready to trade the stress of the unknown for the mechanics of consistent income? The delta neutral strategy proves that with the right foundation and the right rules, the market's chaos can actually become your greatest asset. Thank you so much for joining me for this explainer. I really hope this breakdown empowers you to look at options trading in a whole new low-stress light. Keep learning, and I will see you in the next one.